With the US presidential inauguration around the corner, many prominent activist investors are keenly anticipating Trump 2.0. Joining me to explain why is corporate defense expert Kai Liekefett. Now, Kai, although not all activist investors supported Trump's election, for those who did, why would they be welcoming his presidency in terms of policy?
Well, there are three main reasons, Paul. Number one, it's taxes. It's all about taxes. Trump, in his first administration, adopted massive tax cuts set to expire at the end of 2025. And activist investors, like many other investors, hope that those tax cuts will be extended. The second reason is deregulation. Trump was campaigning on a promise to deregulate America. And the hope, just generally speaking, is that deregulation will result in more economic growth. And the third issue, though, is a little bit more complicated. It's tariffs. So as you may know, tariffs have been threatened by Trump across the world, starting with Canada and Mexico. And some activist investors I spoke to say, well, look, there will be market disruption as a result of those tariffs. That might not necessarily be bad for us activists because it's going to result in market dislocations that we can exploit.
The man himself is impressionable, to say the least. How friendly will the Trump White House be to activist influence?
There are a number of activists who are close to Trump and will certainly try to influence him, starting with Nelson Peltz, who donated significant amounts to his campaign. Paul Singer, founder of Elliott, probably the most sophisticated and best activist in the United States. Dan Loeb of Third Point, Bill Ackman from Pershing Square, and of course, Kai Liekefett. However, during the first Trump administration, the SEC was actually more company-friendly. It proposed regulations of proxy advisory firms like ISS and Glass Lewis, which was welcomed by corporate America. The Trump SEC also tightened the requirements for small shareholders to submit non-binding shareholder proposals. From a company perspective, this is not necessarily bad news that Trump got elected. The incoming SEC commissioner, Paul Atkins, is widely seen as an excellent jurist, very even-handed, and will likely restore the SEC's focus to what it used to be, which is the protection of investors and of the capital markets.
We're also going to see a huge shift in the FTC's approach to M&A and in antitrust enforcement. What's the story here?
The Biden administration was extremely hostile to mergers in terms of antitrust enforcement. A lot of constituencies on Wall Street, but also on Main Street, were extremely unhappy with the way the Biden administration chilled M&A. Now, Trump has already announced the replacements for the leadership of the FTC and also the DOJ's antitrust division. And those replacements are seen as a return to normal. And that's important for activists as well, because the number one exit opportunity for an activist is M&A. Activists are typically trying to push companies into a sale, in particular, target companies who are in the small and mid-cap range. So M&A is key for activists, and they are looking forward to having a liquid M&A market again.
So what's the time frame on this? Should companies be bracing for a disruptive proxy season?
Absolutely. Activists were chomping at the bit. They were popping champagne when Trump was elected. We're already seeing it. There are activists left and right approaching companies in the United States and abroad. And look, companies need to buckle up and prepare themselves. It is much cheaper to get prepared and avoid activism than to deal with an activist campaign. So the time to prepare is now.
Thanks for watching. Learn more by going to sidley.com and searching for shareholder activism. Click now for more of our videos from North America, and please subscribe for the latest international business insights from worldfinance.com.